Give us a little bit of the perspective across the pond on what's happening with the geopolitical uncertainty, with tariffs and stuff like that.
Well, it's actually quite mixed. In the UK, I don't know if you guys have noticed, just looking at some of Trump's pronouncements, he seems to have warmed. He seems to have bonded with our Prime Minister, Keir Starmer. So he often says, in comments that he makes, that he likes Keir Starmer. He said that quite often, quite persistently. So, maybe worth taking seriously. And maybe that's reflected in, the political attitude towards the White House from number 10 Downing Street, because he does seem to be treading a very, very fine line, not trying to precipitate any sort of explosions in terms of commentary or actions by the White House or the US towards the UK. And that's reflected, that sort of strategy seems to be reflected in the fact that we were among those countries that got the minimum tariff, which is like 10%, blanket 10% on all goods, which, in this environment is actually deemed to be great, basically, right? Now, of course, that's probably partly because since we left the European Union, we're obviously not regarded as part of the bloc. And of course, there are certain tariffs across the bloc which are way higher than 10%. So there's a little bit of that. And of course, if you look across the pond in France, Germany, and other major European, sovereigns, basically sentiment towards the White House is a lot worse, not nuanced at all. Germany, lots of intemperate commentary coming from Berlin and also likewise from Paris as well, from Macron and co. So yeah, it's a bit of a contrast. That's how it's being seen. So far though, as far as I'm aware, I don't think there's actually been any retaliatory tariffs apart from, as you know, guys in China. So that's what it's looking like so far. What do you guys make of that 34% retaliation by Beijing? Yeah, what do you think? I mean, there was clearly a direct impact in their markets today, Phil, and I think maybe you guys in the state, you're sort of like, you're on Wall Street, it looked like there was a little bit of a chance of a slight bounce before that came out, just looking at the futures.
Yeah, as soon as the news came across the headlines, futures immediately dipped 2%.
Yeah.
The thing is, like, when it comes to like retaliation, like in a trade war, my base assumption is nobody wins the trade war. There's just degrees of losing here. So China is an economy that's like roughly in line with ours in terms of size, plus or minus a little bit. So they can kind of put the pressure on and they can take some of that. Well, they're already in a little bit of economic turmoil. So at this point, if you do a little bit more damage with some tariffs, if you think it's going to hurt the US more than you, I mean, may as well try to do it, right? Also,
but the problem is no one knows.
That's the thing. Nobody knows. And then the other thing is, if you wanted to, from their standpoint, the US isn't the only trading partner they have. They manufacture for most of the world's goods. So what they might look to do is make alliances outside of the US, and then they can use that 34% retaliation and say, look, we're sticking tariffs on them, but like, if you don't want to, come to the negotiating table and we'll sign a free trade agreement. So that's what I would expect to happen. If you were thinking cooler heads were to prevail, markets clearly are being disappointed right now by what they're seeing. Certainly we were expecting a baseline universal tariff between 10 and 20%. We got that. But what we weren't expecting is a new formula on,
crazy formula,
non-tariff trade barriers to apply to other countries. And so I think that's the reason why you're getting such a steep sell-off in risk assets. And certainly, I mean, this is, we're seeing like a falling knife dynamic basically in the equity markets. Bitcoin, surprisingly, showing a little more resilience. So that's good news. But what Mark was saying is absolutely right. Look, the rest of the world, or I should say, China trades a lot more with the rest of the world than the US trades a lot more with the rest of the world. So they have more existing, relationships than the US does. So as we kind of isolate our trade and put up some of these barriers, they are looking to probably negotiate more agreements, abroad.
At the same time, you have to always remember that the Chinese economy is quite a bit more managed than the U.S. economy. So like what we saw in the first trade war is that the U.S., put on its tariffs and with the intention to narrow its trade deficit with China. And what actually happened is the trade deficit with China widened because China essentially redirected its imports away from the U.S., such as soybeans that they like to consume, and started importing that from Brazil. And meanwhile, the U.S. consumer, who is much more decentralized, as we would say, doesn't have as much control by the U.S. government, continued to consume the goods that are produced in China. So in the net, the balance shifted further away, and the trade balance widened, and that's everybody's going to lose if you kind of continue going down this path. It's like a game theory prisoner's dilemma where if both of the actors do the worst case scenario, you get the worst outcome. So that's let's see if the tariffs stay on, if these leaders continue to kind of butt heads at each other, that's going to be the worst case outcome. But we'll talk more about that in our outlook.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken O'Deleger, Head of Content, and as usual, I'm joined by my colleagues, Gabe Selby, who's Head of Research, and Mark Bilipchuk, who's our Research Analyst. Hi gentlemen.
Hey Ken, great to be here.
Guys, we've got an exceptionally timely episode for you today, because it's less than 48 hours after Donald Trump's Liberation Day tariff announcements on US trading partners, which obviously triggered a severely negative and ongoing price reaction by markets. Now, with so many indeterminate variables, forecasts are going to be challenging from here, but that's exactly what we're going to do today, as this edition is the research team's just released market outlook report for Q2 2025 edition. So that's what we're going to talk about today. We're going to go through the report and tease out the main takeaways for your use and listening pleasure. So guys, the report is divided up into several sections, beginning with a market recap. Did you want to sort of like look at that in a way as a sort of runway for where we are now, or do you want to jump straight into the outlook?
I think it's beneficial to kind of take it back just for a minute and kind of, get that perspective of where we're at and where we're heading. So I think, if we jump back to the last outlook, we were really highlighting the animal spirits that we're seeing in the survey data and the soft data, as we say. So these are things like consumer surveys, business surveys. This is different from hard data that we would, see in jobs reports or something like that. But the animal spirits after the November election were just extraordinary. I mean, consumer optimism, business sentiment was shooting up. And what's been kind of amazing to see, unfortunately, is how fast that's been evaporating, from our dashboards. So with that, in summary, we're expecting to see the U.S. economy kind of continue to kind of experience slowing momentum. So the softer data is going to lead us lower and the harder data is going to follow. Right now, the hard data is actually not that bad. We just had a jobs report that sizably beat the survey expectations by a wide margin. But we know that survey was, in an observation period of last month. So the question is what happens next? And so with that, I think we're seeing these new tariffs. It's going to continue to kind of weigh on consumption. It's going to weigh on trade, and it's going to weigh on investment decisions. And that's kind of what we talk about in our outlook.
One nuance which I noticed, the second paragraph of market recap says, however, by mid-quarter, market sentiment turned sharply risk-off amid rising macroeconomic uncertainty. Now, some of that wasn't actually tariffs, was it? Because we actually saw a bit of a tailing off in the strength of the economy beginning then. It may have been sort of like an admixture of anticipation of what we're seeing now, and a little bit of like extraneous factors as well, because we saw obviously a cooling off of inflation, but that jobs report, the prior jobs report before the most recent one, was not exactly firing on all cylinders. Is my perception, on course?
No, yeah, the job, there was that weak jobs report that came in, and that was largely due to seasonality. The weather in the U.S. was colder than expected, and that seasonality resulted in slower job gains there.
Right.
Yeah, it's fair to say like that was, this could be viewed as a payback report. And again, this is just one data point. So we really shouldn't put too much emphasis on, the most recent NFP report. I think, the real question is, can the U.S. economy, can the global economy absorb these tariffs and absorb a trade war? That's going to be, the elephant in the room. What we see kind of in these other data points that are, that have already happened in the past, and what Mark was saying is absolutely right. You had some anomalies impacting the previous numbers. That's kind of become irrelevant now. And I think you got to shift your focus now to what's ahead.
Frankly, yeah, absolutely. I've turned the page now, guys, onto the growth outlook. By the way, guys who are viewing and listening to this, what you need to do to follow along with this episode is obviously go to cfbenchmarks.com, navigate to the Research and Insights tab, and click down the list. It's going to be the first item, at the top of the page. So then, you can actually have that open while you're listening to the podcast, right? So what I want to do, guys, is actually on that page, Growth Outlook, I've got this chart. I love you guys' charts, as you know. Trade uncertainty to stall CapEx. And what this is NFIB small business CapEx plans. That's the one data source. And US economic policy uncertainty index. So that's a trade category. And it's like, so basically sentiment versus hard data. Another type of data. And if you look, after running quite stable for quite a while, the economic policy uncertainty line just shoots up, obviously, as we come to the end of 2024 and into 2025. So you can already see that people were starting to expect that we might hit the maelstrom that we've actually hit in reality now. And obviously, you basically have the cross of these two lines. So maybe that's a way of getting into what you guys are expecting to accelerate as we head into this phase.
Yeah, just real quick. This is basically a survey that, we run with small businesses that NFIB runs. And that's an important chart because what we can see is in November, this thing was shooting up. So there was a lot of intentions to do a lot of business investment, large scale CapEx. Now, once you've introduced the uncertainty of trade policy and these tariffs, that's kind of evaporated quite quickly. And this kind of led us to the second chart where we can see economist surveys on their growth outlook have moved down considerably. And I think that presents a growth scare type dynamic where we could, materially undershoot the 2%. Let's just say I think it's 1.9% real GDP growth. Again, we don't have GDP estimate at CF Benchmarks. We are using the consensus and kind of having that kind of guide us. And then we kind of just can use that as the benchmark and say, do we see, upside risk or downside risks to that figure? And right now, I think it's fair to say we see downside risks to a 1.9% real GDP growth for 2025. As it pertains to Bitcoin, though, we were just talking about how it's interesting to see Bitcoin's relatively resilient price action. So in that theme of the portfolio perspective of the growth outlook, I think it's fair to kind of point out to the audience that this regime that we're in, that kind of remains to be structurally appealing for Bitcoin. And I think that's because of this policy ambiguity that you're getting from all the world leaders and from the US, with their tariffs and how they might respond internationally against the US. That's creating this demand for a safe haven alternative could be likened to gold. And that's where Bitcoin, attractively sits in that category. So this is one aspect of it. Again, if we do see material weakening in GDP growth, the other aspect is the possibility of, the Fed having to put their foot on and start to print money again. So that would be likened to the dollar debasement story. And that's another kind of feather to the cap of Bitcoin.
Yep. And on top of that, too, when we think about policy responses to a potential slowdown, another one that we often see is on the fiscal side. It's more likely than not that there's going to be some type of tax cut to attempt to offset the tax increases. Or should the economy take a turn for the worse, we could see outright, subsidies going to different industries So say our agriculture is particularly going to be hard hit by this. It's fairly likely that we would see some of that money that comes in from tariffs go back out. And with the end result,
that's where we saw the first subsidies in the last Trump administration, of course.
Exactly. And doing that, we could actually see the deficit blow out or increase, which further strengthens the case for Bitcoin. And that's when Bitcoin tends to do the best.
Yeah.
So
it's brilliant.
In the short term, we'll see higher correlations maybe to risk assets, but in the long run, it's going to be constructive for Bitcoin.
Yeah. Just a bit of color for this section, because I was obviously deep in, as I said, Wall Street economists reports last night, quite a few already out there. And I noticed that, if I'm not mistaken, Barclays actually published, their economists seem to be the worst, most pessimistic, in fact. Their team were expecting a contraction, 0.1% contraction of GDP in 2025. I mean, of all the sort of negative sentiment that we're all aware of, that does seem to be a bit of an overreaction. But what's the rational, driver of that? Clearly, I think that they're not completely spitballing. In what world could we actually see that happen, guys?
Well, if you look at some of the nowcasts, the Atlanta Fed has a nowcast that is pointing to a negative print in the first quarter. And that's even accounting for, this anomaly of gold trade imbalance that's being shown up in the numbers. That's probably would be pushing their model even further negative than it normally would be. But it's certainly possible. To answer your question specifically, I think it's the consumer. So if you slap on these tariffs, if you destroy demand, that's going to scare the consumer. And what really drives the consumer, it's the confidence, that they're going to get, they have a brighter future ahead, that they could find a better job, get pay increases, have more disposable income. If you start to take that away from them, they're going to take back their spending. And that, creates this opportunity in an economy that's 70% or so driven by consumption. That's where you get that rate of change of a negative number on the pullback in consumption.
Yeah. Yep. And just before we wrap up the growth outlook section, I just want to read the portfolio perspective call out box, which is on that page. You guys can see it, find it yourself. But for our purposes now, we remain structurally cautious on US growth in 2025, particularly in the first half, where downside surprises are likely relative to consensus forecasts and stagflationary risks are on the rise. So that essentially does seem to suggest that you're expecting momentum from this snapshot, if you like, to actually carry on into forthcoming quarters. Is that a reasonable way to read it?
Yeah. So what's going to kind of happen with these consensus forecasts as time go on is analysts will slowly revise down. And we've actually seen this on, say, S&P targets over the last couple of days. If you look at the back of the report right now, we have a snapshot from a couple of days ago. It shows 20% upside in the S&P on the year. I saw this morning most banks cut their targets under 6,000. So that's generally what is kind of going to happen with the direction of those forecasts. So there is definitely that downside risk, especially in the first quarter, when all we have right now from the policy is the tariffs. We don't have any clarity on tax cuts, budget increases, or what other countries are even going to do outside of China as of now.
Yeah, absolutely. All right, then we go on to, just as importantly, the inflation outlook, if I'm not mistaken.
Well, I was just going to say, this is a tricky one, and this is kind of where it becomes a bit of an unusual environment for I guess most economies. Typically, when you get to see demand destruction or slowdown or weakening, I just gave you, 3 different degrees of, what we could see from severe to not so severe. So weakening being less severe, but typically you see inflation also follow that. Tariffs introduce interesting variable where you might actually see, inflation rise as you see demand slow. So that's something to consider. And that is something that's also going to cloud, I think, the Fed's outlook in the near term. So what Mark was saying, is totally fair. I think you should continue to expect to see a more reluctant Fed. If you're waiting for the Fed to kind of talk about a Fed put, they understand the upside risk to inflation, And this is actually even before the announcement of Liberation Day, where we had the where we had the tariffs announced. We have a chart in here where we have the FOMC risks to core PCE diffusion index. So this basically surveys the 19 voting members of the FOMC, and 18 of the 19 see upside risks to core PCE. And if you look at the speech that Jerome Powell gave in his March press conference, tariff was one of the big words that he said frequently. So they were kind of expecting, this possibility
sure.
of upside risk to inflation. And then certainly, we have other indicators that we're highlighting, such as the ISM manufacturing report, which has a prices paid component. This one tends to lead CPI year over year quite well. And so that's something that's pointing to upside risk. If we look at University of Michigan consumer expectations, this is an interesting dynamic that we're seeing because through the last inflation cycle, long-term inflation expectations were actually pretty well anchored. However, inflation hasn't really picked up yet, to the degree that some are anticipating. And we're already starting to see consumer expectations for inflation shoot up. And so I think they reached a 32-year high in the most recent report. So there's just a lot happening that's pointing to upside risk to inflation right now.
Longer term too, I think it's also important to mention that there's a couple of things that are going to happen with tariffs. And when we look at CPI expectations, the first thing that's going to happen is just when you add the tax on the end of it, the price level will increase one time. What's much less clear though is it going to be a long-term inflationary force as supply chains change? Because it's not just where the U.S. purchases. If other nations are making free trade agreements with each other, it might be more attractive to export elsewhere, which could stress U.S. supply chains, create that supply-demand imbalance, and then persistently kick up inflation and keep it higher. So there's real upside risk here when you change this many supply chains at once.
I wanted to ask you guys, because I'm looking at the portfolio perspective section on this page, and I quote, it says risks are now tilted decisively to the upside for inflation. For investors, this environment warrants tactical inflation hedging through increased exposure to sound money assets that can protect purchasing power over longer time horizons. Now, that does seem to include Bitcoin. That seems to be the implication. Can you guys elaborate?
Yeah, I mean, I think that Bitcoin it's almost been, to me, mispriced through all this. So if you look at our other our long-term store of value kind of inflation hedging instrument is gold. We've seen gold rallying into all of the uncertainty as maybe central banks have changed their reserves and investors have moved their portfolios. And I think that this kind of creates an opportunity within Bitcoin as it goes after that same store of value market and has room to gain market share there. It has some real potential upside to it.
Yeah, you're spot on. Look at the relative performance leading into this. Bitcoin's lagged considerably. Look at the market cap of Bitcoin relative to gold. It's less than a tenth of its size. So there is catch-up potential for Bitcoin. And I think tactically, speaking, this is a word that we used, is that there's probably going to be dislocations. So it's a risky asset. You're likely to see sell-offs in Bitcoin even further. However, if you have a tactical entry at an advantageous level, over the long term, it can protect your purchasing power quite well. And in a world where upside risk to inflation could be transitory or non-transitory, I think investors are going to find that appealing.
Yeah. Now, one of the things I mentioned earlier, I'm having I'm rethinking basically, because I'm almost thinking there's nothing that is extraneous to what we're experiencing right now. But clearly, that's maybe an extreme case. The fourth paragraph on this page, the inflation outlook, reads commodities, food, and the risk of pass-through. That's the headline. Tariffs are not acting in isolation. A resurgence in food and commodity prices driven by weather disruptions, fragile global supply chains, and trade distortions is reinforcing the inflation pulse. So this is kind of speaking to what I was trying to get at earlier, other factors beyond the inflation and sort of like economic impact of tariffs that we may have seen acting a little bit beforehand. But what is your view on this now, guys? Because it just kind of like does seem quite difficult to, break them apart in my mind. They do seem to be quite strongly intertwined. You can obviously get fragile global supply chains being impacted by tariffs even further. Likewise, obviously weather disruptions stand independently, but they can exacerbate what we're seeing already from the White House. So how much weight would you put on the commodity factors like food and the risk of pass through to the economy aside from tariffs? Is that helpful?
Yeah, I think that helps. Aside from tariffs, it's not likely that you're going to see, commodities really, I think, add a lot of push to the price, to inflation prices, basically because if you think of commodities, they do have a cyclicality component when we talk about like things that are, in the real economy, like crude oil or industrial metals such as copper, steel. So it's not so much going to be probably the demand side. I would weight in the factor of the tariff, really. It's just the supply side. You might find that, for certain commodities, the inventory levels just might not be there because, there's going to be less production because they're anticipating less demand. And that's because, there's a tariff that's being slapped on at the end of the product. And that's going to, naturally cause some aversion for consumption. So I think really for commodities, to answer your question, it's really going to be driven, the inflationary upside pressures through the pass-through of the tariffs.
Absolutely. Right. So we should move on to the meaty subject of the monetary outlook now. And, again, we can lead this in with maybe the FOMC inflation concerns rising again chart, which is on the same page. Now, this maps core PCE year on year against the FOMC member risks to core PCE diffusion index, which Gabe mentioned earlier. And there's a bit of a sort of like divergence emerging here. Clearly, we are in early days, but from 2024 onwards, a clear divergence between these two does seem to come out. And of course, the bias favors the FOMC members' risks to core PCE diffusion index. Maybe you guys can get into this part of the discussion, based on that chart.
I mean, really, we just try to connect the dots here because we know kind of like from the meeting minutes that the tariffs that were being proposed at the time were of concern for FOMC committee members. That showed up in the diffusion index. That's showing up in this word cloud chart that we put together on the Outlook,
I like that.
where you see things like good, economic, stance, inflation, strong, solid. And then there's that, the word tariff that's also kind of pronounced there. So the dots are being connected. And I think for the Fed, it's really just a cloudier path. That Fed put that Mark's talking about likely to be on hold for now. And I would just say, things can change rather quickly when you're in this type of environment. And that goes into one of the lines that we put in there, that the risk of a policy mistake is increasing. So the policy mistake in this instance would be that, the monetary policy stance that they currently have, which I would consider to be restrictive, is too restrictive and they are too slow. I think if you look at how consumption is leading, consumption is primarily driven by income growth. So if income growth is slow, then don't expect the consumer to spend more. They have less disposable income. So we know that, disposable income slowing, below the current overnight Fed funds rate, that typically leads to not good things. That typically leads to, an adjustment that needs to be happening at the central bank level. So that's kind of in summary of where we're at.
Yeah. Can I like just on one small point there? Because I think that chart, the word chart that you guys have got, which, for listeners who maybe don't have this in front of them, I guess what this does, it weights the use of the term by frequency in recent, Federal Reserve commentary. And then, you get the size of the word, it reflects that term frequency. Because in that chart, it's actually more insightful than you guys maybe even are aware. Inflation is way bigger than tariffs. And in fact, the word good is actually almost pretty much the same size as tariff. So that to me does suggest that there is a bit of a risk of, the FOMC mispricing certain risks over and above others, which maybe should be priced a bit more significantly. So there is that.
It's great that you brought attention to that, Ken, because I'll note one word that is not on there, and it's unemployment. And if you think about their dual mandate, they have the unemployment and the inflation dual mandate. And Powell was actually talking about that this morning. He says, right now, the risk is to the upside on the inflation part of their mandate. But if there's a change and the risk becomes to the upside on unemployment, they can pivot and turn their attention. And just when you think about policy expectations and where they can go, and you have to look at where they are, he commented today that they are still slightly restrictive. So if we think about getting to a neutral rate would be the next step if you wanted to shift. And there's debates where that is 3.5%, much lower.
That's a really important sentence there. Getting to the neutral rate is the next step. Historically, how has restrictive to neutral, how has that, sequence gone?
Typically it goes, we go restrictive straight through neutral.
Yeah, straight through neutral. So we've had soft landings in the past. It's not impossible. It's not impossible. It's just becoming less probable.
Plausible, basically.
So, yes, the risks are growing, and that's what the market's pricing in. So that's what I think, is just important, is just to understand, we all know kind of that the unemployment picture is relatively okay. It's, we've seen the labor market continuously cool down since its incredibly strong prints, but it's I think right now it's about keeping your eyes around the corner. That's the important thing. Things can move rather quickly. So, going to neutral would be the soft landing. And we're not ruling that out. We do think that there's room for a pause here, given to the points that, Mark's been saying. But at the same time, we increased our total rate cut count to 4 this year, all coming in the latter half of the year. So we think there's a little bit of a pause, but ultimately a Fed pull would come, further down the road. Again, a lot of uncertainty going on.
Yeah, just one small point on, because that word chart, I think is brilliant, actually. But there is one small consideration to bear in mind. Obviously, the FOMC will be very cautious in its commentary at all times, right? So they're not going to use the word unemployment unless, 100% warranted. And clearly, they're not going to introduce it in such a way that can potentially telegraph expectations when they don't have those expectations yet. So that's one thing probably that might help explain its absence from that chart. But guys, portfolio perspective on this one. Does anyone want to have any burning points that immediately salient, or do you want me to read it out and we can go from there?
Well, this was kind of like a relatively fun one. Mark and I have been talking about this possibility of yield curve control as a new shiny lever. This
a Japanese invention, I seem to remember.
Yeah, and the U.S. actually
largely. Well, yeah. in modern times.
Yeah. But let's go to some various scenarios. So one, we get some cost push inflation through tariffs. We get a slowdown. Fed stays on hold for a bit because they see the inflationary mandate being overweighting the risk to the unemployment mandate. That creates the opportunity for policy mistake. Then you start to see the cracks in the real economy. You start to see labor markets really cool off. That leads to, further deficit spending because you have all those transfer payments from unemployment claims. We already know where our deficit is. We already know that the deficit hasn't really improved this year despite, Doge's best efforts. That's going to lead to more supply. We highlighted last time that, we're getting to those levels on our deficits that we've seen historically bond vigilantes show up. So if we do go down that road of a policy mistake, I think the possibility of, the Fed intervening in a new manner or relatively new manner and in providing, some sort of cap on yields to help ease the borrowing costs, that's still, a possibility in that type of route that I just kind of outlined. And so it's really helpful to have this conversation, on our outlook, but this just adds another dollar debasement narrative, right, to Bitcoin. And kind of the sound money principles that we talk about with having, something counter to the fiat currency that's, manipulated by central banks.
Yeah. Mark, any points on this one?
I think Gabe summed it up pretty much perfectly. And Yeah, with the Fed, definitely be on the lookout for anything. If you've noticed, whenever these crises tend to happen, they always call it something different, but at the end of the day, there is that debasement to watch out for, and that's what we're looking for.
Yeah. We've obviously mentioned Bitcoin quite a lot in this conversation already, but you've got a much broader bird's eye view than most, including me, of, other assets, protocols, sectors, if you like, if you want to put things through a CFDAX perspective. Are there any other assets, digital assets, that you'd be looking at as well, apart from Bitcoin, in that ilk?
What I'm going to kind of be watching for through this. So when I think about our other assets and kind of what they do in the crypto space, Bitcoin is the only one that has that store of value, protect your purchasing power narrative that has proven over and over again to benefit from some of the debasement that would come on the back of a slowdown.
Yeah.
On a lot of other protocols, if we look at the activity that generates value on chain, a lot of it is speculation in highly risky financial assets. And typically when you see liquidity come out of markets like this and it's in a sell and it sells off in such a quick fashion, that type of activity is kind of the first to grind down to a halt. And we actually saw this. If you look at Ethereum and Solana's monthly revenues,
great point.
Since January year to date, we have Ethereum doing less than 20 million a month in revenue, down from highs of 1.6 billion in 2021. Solana has fallen 60% in monthly revenue 2 months in a row. So what I would watch out for here in terms of other assets is what kind of holds up, what still has activity on chain as there's a washout in equities and as people make that flight to safety.
Yeah.
So it's really going to be the larger cap kind of blue chip L1s that's going to stick to. So that's kind of where I would be defensively positioned into this.
Brilliant.
It's kind of like the narratives that we're going to be highlighting in our secular themes. We have different narratives for different protocols, for different tokens. I think that despite the fact that obviously some of these macro narratives are really directly applying to Bitcoin specifically, we're going to start to maybe have more of a, like you could call a stock pickers market, a token pickers market, where you see some of these tokens that have had, significant drawdowns. And if you, stick with us, you read our research, we're going to try our best to highlight some of these themes, and you can follow along and see if they play out. So, I think for something like Ethereum, right, Mark, I think we talked about that in the report. And so you highlighted the incoming upgrade, which is Pectra. Yep. And so it's going to be something that, Ether price has already fallen over 50 to 60, almost 60%.
Yeah, we're close to 60% from the January highs. Yeah.
Wow.
So meanwhile, the store of value narrative that we've been talking about for these other macro themes, like where do you see some potential for Ethereum following this upgrade?
Yeah, so I think first we should probably talk a little bit about the upgrade and what it's going to bring to Ethereum. So it's got two major components. It is a UX and a scaling component. So on the UX front, right now, Ethereum's blockchain is pretty clunky to use. If you're familiar with it, you have to go in and to do a swap, you'll have to approve a gas limit and then approve a connection to the wallet and then approve the actual swap. You're clicking multiple times, paying multiple fees, and that does make it difficult for non-crypto native users to get into it. So what Pectra's UX upgrade is going to do is it activates what's called account abstraction, which is going to make these wallets programmable so you can batch all these transactions together and have a seamless one-click experience. A lot like what's on Solana, and we saw drew 10 million users onto it in the span of 12 months. So that's exciting on the usability front. And then on the scaling front, we have a couple of things. We have a blob count increase, which is going to make the layer 2 throughputs higher. So what we're starting to see are shorter and shorter block times on layer 2, a lot of them going sub 1 second to get that instant settlement. And what that's doing is creating more data blobs, which is making it more expensive to operate layer 2s. The goal here is going to be to reduce that so that the transaction fees stay low at high volumes on L2s, which will be critical if you make it easier to use. And then we also have some on the validator and staking front. This is big for, I think, institutional participation, because it's going to do a couple of things. It's going to increase the max validator size to 2,048 ETH. So you have less validators to manage if you're a large institution holding. And then the other thing it will do is reduce the time to unstake from weeks to about a little less than a day. So if for liquidity management, if you have a staked Ether as an institution, you might need a short-term credit facility to make payments while you're withdrawing. That's just gone and reduced the time and kind of made it easier to get those financing terms and just generally made it easier to manage in a portfolio.
Perfect. Guys, do you want to talk about the regulatory now?
Yeah.
I think what you just said, Mark, kind of feeds pretty well because, with Pectra, you're getting more throughput. You could see better user interface. We're going to see an improved architecture for the validators. Now, Ethereum has been the chain of choice for a lot of these stablecoin, these money market funds, real world assets, to that degree. What are you seeing in the regulatory side coming around the corner? There's been a few talks. There's been a few pieces of legislation that have been proposed. We have the Genius Act, which I think is in the Senate, in the Senate. And then we have the Stable Act, which is in the House. Can you break down kind of like what the differences are between those two? What's going on with them?
Okay. Yeah. So with the first regulatory push we've kind of seen in crypto that's gained traction in Congress and in the Senate has been our stablecoin acts. And there's the two bills that are floated right now are the Genius Act and the Stable Act. The similarities are they're going to introduce a procedure to become a regulated issuer. They're going to have audit rules for the backing of the stable coins, as well as rules as to what assets specifically can be used to back the stable coins. So right there, that's going to kind of work to increase investor confidence, and it's going to allow for a lot more users to be onboarded that were previously sitting on the sidelines, where there were maybe less disclosure rules and a lot of stable coins were really offshore too. So there were, if you look at it now, roughly 70% of the stablecoin market cap are these non-US issuers, and these are unregulated. They're not subject to the same audit rules, and they really aren't going to be as institutionally viable, and they're not going to gain as much retail traction. So what
we all know how those offshore crypto projects can sometimes end up.
Yeah. Yep. So what the bill kind of aims to do, in addition to that, is they're looking to kind of create a rule for institutions where they have to use a regulated issuer. So there's going to be this large onshoring of these stable coins, because if you want to work with Visa or you want to work with MasterCard, as they've now talked about implementing stable coins for payment, you're going to need to be a regulated issuer per both of these bills. So now you're going to need to move your operations to the US. So we'll see players like banks, we'll see existing payment processors step in or increase their presence. And I wouldn't be surprised if we saw existing US tech companies begin to merge some of these crypto wallets or stablecoin services payments, maybe social media apps kind of all in. So there's a lot exciting there. Now, the key difference between the two bills is one is going to allow the actual stablecoins to be yield bearing. So it will, if you hold the stablecoin in your wallet, you'll be able to earn the T-bill rate in real time. Now, the other bill is looking to label yield-bearing stablecoins as securities, and for payments, they won't be allowed to bear yield. The idea being that it would protect deposits in banks, because if you have all your deposits in a checking account earning 0%, you can put them in the stablecoin account earning the T-bill rate, and with MasterCard, you can pay with it. You suddenly have much less need for a checking account. So there is a risk that bank reserves could drop. So that's what they're looking out for.
So aside from that, there is another aspect of the regulatory outlook, which you guys touched on in the report, and that is, to read from it again, we anticipate that a market structure bill will be passed following the August recess, which seems so far away at this point, and will build on the groundwork that was laid in FIT 21, an early incarnation of a really broad crypto-facing right-sizing legislation that went through, I think was passed, certainly on the floor. A comprehensive market structure bill is expected to establish clear oversight responsibilities by delineating authority between the CFTC and SEC. So this will be essentially of more relevance or stronger relevance for the traditional financial participants within crypto. Maybe you guys can elaborate a little bit on that, about how this might work out and the implications of it.
Yeah. So I think some of the key things when we think about the market structure bill that we're watching for, it's going to be who has regulatory oversight and then over what. So is it going to be what's going to be a digital asset security? What's going to be a digital asset commodity? And then the other thing that's going to be important are what are the disclosure rules going to be for that? Because that's going to dictate, when you're forming a new project or you're thinking about issuing a new token, that's going to dictate part of your process. So those are the key things that are going to influence.
Another thing to just highlight is the timeline. I think we are expecting stablecoin legislation to be kind of the low-hanging fruit right now at the moment, and for a broader market structure bill to be kind of coming after the August recess, which in layman's terms, August recess is basically where they just, go away for a full month and have a nice little break there. So I think that unfortunately the heavier lifting for the market structure bill is going to happen after that.
Yeah.
Yep.
Yeah. Sure. Guys, we're probably slightly more than halfway through, and we've already touched on, in terms of the secular themes, which is the next major section that we're going to talk about. We've already touched on Ethereum. I can see that there's, we also have the first factors section for of this report series. But before that is actually something which I think is maybe something we can't miss, the staking section. And the headline of that is staking to drive ETH ETF flows. So I think we really can't avoid digging into that. Who wants to take the beginning of this?
Okay, yeah, I can go ahead and kind of kick us off a little bit. So earlier in the year, we've seen the exchanges file to add staking to Ether ETFs. And this is, in our view, the huge unlock, because if you think about Ethereum's return stream, the staking, the validator rewards are a component of that. And if you are holding the Ethereum ETF right now, you don't have exposure to Ethereum's full total return. So the addition of staking in ETFs really seems like an opportunity for Ethereum to get some of the flows Bitcoin got, where there were people that maybe had Bitcoin in cold storage that they wanted to bring into their ETFs and bring it right into their brokerage account. I think once you get Ethereum staking in an easy solution like an ETF, you might start to see some of those on-chain funds begin to move into the ETF vehicles, and that can kind of start to bring up the AUM in the Ether ETFs.
Yeah.
And to add to that, if you get an in-kind create redeem mechanism, that's another kind of door to open. But Mark, you're definitely kind of the pro on some of this on-chain validator stuff. Now the Pectra upgrade, that shortens the time, right, for staking. So one thing that to highlight is that, before, when you had a larger staking window, if you're an institutional asset manager, you're unlikely to stake a lot of that portfolio because you have to have some liquidity to meet redemptions, for exogenous shocks like we're going through today. But if we were to, shorten that window on when you could unstake your ETH, that kind of opens up another door as well, where you could see a higher percentage or maybe all of the portfolio become staked, right, on an ETF side. So that's a big deal, because now you're earning the staking yield on not just a fraction, even a smaller fraction of the ETH, but you are earning maybe potentially to 80, 90, or 100% of the ETH.
Yeah.
Yeah.
Now we've been sort of throughout this discussion talking about Bitcoin's potential advantage in the upcoming environment, for reasons which you guys have outlined. But there is actually an entire section that deals with this point. It's called Bitcoin's monetary impulse. I mean, we've already talked about it to an extent, but is there anything else that you guys want to add so that we can fill out this part, or should we move on to factors?
We'll just highlight kind of quickly for the audience that, for Bitcoin, a major driver is global liquidity. And it's been this kind of interesting relationship that we've seen play out recently, where the peak in Bitcoin's price kind of followed the peak in global liquidity lower, led by 90 days or 3 months. However, we're starting to see global liquidity pick up. So we're looking at a swath of currencies here from G10 to, I think, even like G20, so we've got stuff like the euro, the Swiss franc, the yen, the pound, obviously the US dollar. And we're starting to see M2 money supply go up in the other direction. So we anticipate, that's going to be a tailwind here for Bitcoin. It should be, but it's a 90-day lead time. So you can expect, some temporarily downside risks until we start to turn the ship around. But it kind of leads us to kind of this discussion on the factors where, Mark saw some interesting, I guess, performance divergence, you could call it, right?
Yeah.
And so which factors performed well over the last few months and which ones did not work?
Before you do that, before you jump in there, Mark, let me just because this is major. This is as you know, or those of you who have been following CF Benchmarks for some time and maybe have been aware of our work earlier in the year, we actually launched probably the first comprehensive digital asset factor-based investing framework earlier in the year, in the beginning months of the year. And this is the first time that we've actually included an analysis based on the framework within one of Mark and Gabe's reports. So to begin with, I believe that you've cut the number of factors down from what's available to 4. Maybe you want to describe the reasons behind that, and then you can go into what you saw, Mark.
Yeah. So what the reasoning behind cutting down the factors is most of the other factors were kind of middling performance, essentially flat over the time period, as these are the full long short factor portfolios that we're looking at against the market factor. So what I wanted to highlight here is if two of our, one of our strongest performer and one of our weaker performers, growth was a strong performer, value was relatively weak, which to me seems kind of odd in a sell-off. But I think that part of that can be explained by the size factor. And that's why I included it. So breaking down the performance over the last quarter, if we think about what did well and what held up and what didn't, it was a lot of these smaller cap altcoins. And we saw this in our QARs. We had those sector specific indices or those thematic ones down 40-50%. And that was largely on small cap tokens. So our size factor is going long the smallest cap tokens and short the largest cap tokens. So that underperformance right there does tell you that the relative drawdown of these small caps was far more than the large caps. So moving into our size and and then when you think about our size and our growth factors, right? Our growth factor is going long the highest TVL and DAU growth and going short the ones with the lowest growth or the most negative growth over a rolling 30-day window. And that 30-day window is critical over the quarter. Because if we think about how the quarter played out, we started off in a little bit of a bull run. Pre-inauguration, we had the meme coins launched by the president and the first lady. And we saw a lot of liquidity come out of other chains and move onto Solana. And what that did within the growth factor, if you look at the individual long and short positions, is you saw that liquidity move out of small cap altcoins, which dropped the DAUs and TVLs on these chains, which caused us to go short a lot of the small cap high growth things, which are what dragged the size factor down, resulting in growth outperformance. And then on the value side, we're looking at DAUs and TVLs against its total market cap. So when this liquidity suck happened, we ended up doing kind of the opposite. We ended up going short a lot of these large cap because of their market caps, and there was a drop in use. And we ended up going long the small caps because the market cap dropped while the active users had already fallen off.
That was a lot, I think, for the basically you had a liquidity vacuum. Yeah, we had a liquidity vacuum that which created a bit of a skew in the metrics. Mm-hmm. And that caused the rebalancing to happen the way it did. And then we saw mean reversion play out. We saw repositioning in the factor portfolios. Is that fair?
That's exactly what played out. So what's interesting on a go forward basis and what we're going to want to watch here is I think we could actually see some of that revert as the on-chain activity is, that was a one-time shock to the system. I don't know if we have the capacity, the liquidity in the market to launch another one of these things. So I think
would you see that reversion also happening for the market factor, which is basically fallen off a cliff under the influences that you actually explained there, Mark? It's way divergent from the other three right now. I mean, just on the basis of mean reversion alone.
Well, remember the market factor is just the long only market, so it doesn't have the short component to it. So it's just showing like what happened. So as the market factor went down, what I would have intuitively expected and kind of would see in other markets is for the value factor to outperform and growth to underperform. And I think we've set up with that skew in the metrics for that to play out in the future. So we'll see how the on-chain metrics kind of move and look. Because as we go through these, we're now deep into correction territory in equities, bear markets on some indices. and we've got that economic uncertainty kind of stalling on-chain activity. So we'll see how the metrics normalize, but I think we could be setting up for value to outperform growth going forward.
Because the market factor, is it not, I mean, cut this bit out if I'm really making a stupid mistake, guys, but is the market factor simply Bitcoin and Ether?
Yep.
Yes.
Returns.
Yep.
Yeah. So, I mean, I don't know.
But
yeah,
one other thing that I just jump back in is the size factor. You know, Bitcoin has had, relative outperformance with all these other altcoins. And that is, I think, a very clear rotation into a relative safety trade within the digital asset space. So it's very interesting to see how we're seeing that actually play out in our factor work, right?
Yeah. Mm-hmm. Yeah, it's the shape of things to come. We're going to have more emphasis on these going forward in forthcoming outlook reports and other reports too. So yeah, something to look forward to. Guys, I think we are at time. We have been at time for a little while. Maybe we can wrap there. But what I want to get you both to do, I think this is extremely invaluable for this kind of thing, is put you on the spot and ask you for a couple, maybe 3 takeaways each. Gabe, I'm going to get you to go first.
Takeaway is careful with falling knives. Okay. If we do get a falling knife in Bitcoin, I like to always wait for a little bit more confirmation. But at the same time, if you have a longer term horizon, you are going to find, I think, some really great discounts, despite the, turmoil that could possibly be coming around the corner. The other thing that I kind of wanted to highlight is that, this could be the environment that we've all been waiting for a decoupling in Bitcoin. So the fact that, I'm looking at my screens, I can see the equity markets, having a really nasty red day. Bitcoin's having a positive day here on a Friday that we're recording, leads me to kind of have some hope for this decoupling narrative that, I think a lot of folks have been kind of waiting to, or it has occurred, but, it could occur again. So keep an eye out on that. And with that, I'll just pass it over to Mark for his.
Yeah. So I'm going to kind of start off with a takeaway that I got out of one of my favorite books, When Genius Failed. It's about long-term capital management. If you haven't read it, highly recommend it. They talk about in times of crisis, correlation tends to go to 1. So right now we're seeing that broad sell-off across the board. The thing to watch for in these sell-offs is the fundamentals, is the if you're looking at different tokens and trying to pick them, look at the on-chain metrics, look at what developers are building, and even look where venture capital is deploying dollars, because that's what's coming down the road. So another key takeaway is going to be here to not fight the Fed in whatever direction it takes. So if we're going to maybe take some time to watch things, then it might not be a good time to catch the falling knife, but when the Fed pivots, pay attention.
Yeah, because the track record recently suggested that's going to happen later than expected or widely expected.
Yeah, it sounds like they might be a little more cautious this time around, but
that's interesting.
But whenever they do make that pivot, we see it moves quick, and you don't move against them when they do it.
Absolutely. Perfect, gentlemen. So there you have it. You could not get a better summation of where we are. So timely. Our Outlook report is basically a look into the next quarter, and it comes at a sort of a critical juncture for the US economy and, of course, for the digital asset class as well. So you need to go, as I said before, cfbenchmarks.com, research and insights, find the report and dive in. That's going to serve you extremely well in the next 3 months. If you like the podcast, basically you also know where to go. Wherever you get your podcasts, we're there. We've got now, I think this is episode 42, so there's certainly enough to keep you listening and watching for several weeks to come. And after that, we'll see you again for the next episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice.
This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.